And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Of course, it is Wednesday. It is also, finally, thank goodness, Liberation Day. We were all liberated. Do you feel liberated today? Just not more liberal. You feel liberated. Those are two different words. So, but anyway, today is Liberation Day. Obviously, we will find out somewhere today kind of what the tariff outlook is going to be from autos to imports to oil to Canada versus Mexico, China, etc. So hopefully we will get some type of sense of stability now in the markets, at least from, and again, as we've been saying over the last few days, it all comes down to earnings, right? So now once I know today what these tariffs are going to be, it's basically a mathematical calculation of what's going to be that impact to corporate earnings. So we'll find out. That should help the markets a bit. Yesterday and the day before, markets have rallied here a bit. Not surprising. Last day of the quarter, first day of the new quarter, seeing some positions put back on portfolios. Yesterday, the Mag 7 was driving the markets. Again, just not surprisingly, they're down 15% for the year. Seeing some money flows come back into those very oversold stocks. But the question is going to be now sustainability going forward. And a lot of this will have to do with what will the impacts be from tariffs on not only just earnings, but also on economic growth, right? So again, the big question, as we've talked about before, is producers pay the tariffs, but can they pass that tariff on to consumers? Will consumers pay higher prices for the things that they want, or will they find substitutes? This is going to be one of the big challenges for economists to try to figure out, and we'll see. So we'll kind of get some clarity today, and that should help the markets. If tariffs come in, look, and this market is primed for a very big move today, one way or the other. If tariffs come out today and they're not as dire as expected, we could have a very big move to the upside, 1.5% to 2% on the upside today in the markets. If tariffs are more onerous than expectations, we could have a 1.5% to 2% downside today. So again, there's really no way to hedge today to any great degree, because again, the depending on what's said, how it's phrased, what the what the predictions are, and kind of what the goals are. Right? There's going to be so many different impacts to the markets. Again, they could come out today and say, hey, we're going to do 25 or 50% tariffs and everything, but as soon as those will go away, if China or Europe or Canada or Mexico remove their tariffs from whatever, right? So again, there's going to be so many different nuances coming out today. It's almost impossible to hedge this market, really for what's going to happen. So we're just going to have to work our way through this today, and then kind of figure out what happens next. But as we get into kind of talking, when we do our before the bell here in a second, we'll talk a little bit about what the ranges look like on the markets overall for today. And then again, we'll just have to kind of price this from here. Now, interestingly enough, if you take a look at the markets this year to date, right, markets are down about 6% year to date, give or take. If you own the 493, you're flat for the year. If you own the big cap 7, you're down 15% for the year. So again, this market this year has so far been really about diversification. Bonds have been performing well this year. Gold has performed well this year. So any allocation to gold or bonds in your portfolio have certainly helped limit the downside risk to your portfolio. And this is why we always go back to, it's not just about being in the markets. It's also about diversification of assets in the markets. And again, we own some of the Mag 7, but we also own other stocks, we also own bonds, and so our portfolios are performing much better relative to the overall market. So again, this goes down to stock selection, it goes down to kind of where you're allocating assets, and this is going to change. Now, this is very important. What's working this year is not going to work most likely next year. And this is one of the challenges that we face as investors, is that we get kind of pulled into a trade that's working, right? And last year was all Mag 7. That's not working this year. bonds weren't working last year. They're working this year. So again, those are going to change. What performs generally at the top of a yearly transaction range in terms of what asset class is outperforming relative to underperforming one year to the next changes pretty dramatically from one year to the next. Typically, what's ever at the top winds up at the bottom in the next year or two. So again, don't get complacent with this idea that, I've got the best assets in the world right now and those are always going to go up forever. They're not. And again, this is where we come back to the technical conditions of the markets, what's overbought, what's oversold, because you're eventually going to have a rotation in those assets. That brings us to what you need to know before the bell this morning. So again, today is Liberation Day. We're going to find out. So markets yesterday, we've actually had 2 days in a row now where the market started off weaker. Monday, we were down about 1.5% at the open, rallied back into positive territory by the end of the day. Lots of buying coming in all day long in the markets on Monday. Yesterday, markets opened up lower, rallied back into positive territory again, and we did finish towards the upside of yesterday as well. So again, we've had 2 good days here of money kind of coming in. So 2 important things is that we did form a very nice support level at that recent bottom. So that gives us a little bit of a base to work off of. Are we forming a double bottom here? Too soon to tell, but it's very possible. We'll kind of keep a watch on this. This rally of the last couple of days has kept this buy signal intact. We're relative strength had weakened a bit. It turned up yesterday as well. We're starting to form a negative divergence now with relative strength relative to kind of what's happening with the market. So again, that's also kind of another bullish sign. And importantly, we've seen a pickup in money flows. So we've seen money flows coming back into the market, despite this market really struggling here over the last couple of weeks. We've seen money flows coming back into the market. So there's definitely been some buying in the markets overall. That's encouraging, but also too, we have to remember that was quarter end. So there's a lot of that rebalancing that was going on. So we're not going to read a whole lot into that right now. We're going to pay attention to the technicals. But again, we've got to get through today and how the market's going to respond. There is downside risk to this recent low today. So again, if the markets don't like what the market says, we could be right back down at those lows today, possibly even set new lows. If we set new lows, that's not encouraging. That suggests we're probably going to be looking to kind of trade down to around 5,400 on the index. So again, there is some downside risk here depending on what happens with tariffs. But again, if tariffs aren't as bad or as onerous as everybody's expecting, we've got upside back here to this previous top level here, this kind of support that we were building in the last couple of days. So again, we've got this big trading range that we're trading in right now, and that's likely going to be the case here for a bit. Now, once we kind of get into later this month, one thing that's missing in this market right now is share buybacks. Right now, we're in full blackout mode for all the corporations in terms of share buybacks, but share buybacks are very robust this year. We're going to exceed another trillion. We did over $1 trillion last year in buybacks. We're going to do another trillion this year in buybacks as well, but they are closed right now. We do not have that buying support in the markets, right in the midst of the time that we actually need some buyers to be in the markets. Buybacks are closed out until about 2 more weeks. So in about 2 weeks, not this coming week, but next week, we're going to start hearing from the major banks. Once they report, their window opens back up, JP Morgan, Goldman Sachs, etc. The week after that, we're going to start seeing Apple, Microsoft, their window then opens back up. So by the end of the month, we should have some additional buying power coming back into the market as buybacks open up as well. But also, too, hopefully we'll be kind of far enough beyond this tariff situation that markets have been able to price that in and figure that out as well. So just got to kind of navigate this today. We'll pick back up on this tomorrow with Michael Leibowitz and kind of figure out what the markets did today, then try to assume where markets might move to next. But that's what you need to know before the bell today. In other words, just hang on. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So some sad news this morning. Val Kilmer passed away. He's had a lot of trouble health-wise, for a while, but apparently pneumonia finally took its toll. Of course, Val Kilmer famous for movies like Heat back in the day. It's probably before most people remember that. But most people remember him from, of course, Top Gun. Not just the recent one, but also the original one 20 years ago. So, as Iceman, that is correct. So, obviously, a very sad day there. And just reminds us that we're all getting much older now. So, as more and more of our contemporaries, I was trying to find the right word. Thank you. That's a good word. Our contemporaries are starting to cease to exist. Reminds us that we all are limited in our lifespan here on the planet, so we need to make the best of it.
Shuffling off this mortal coil.
Yes, and we need to remember that we only have a limited amount of time, so no regrets. Do what you got to do. So obviously today, as I was saying, is that today is Liberation Day. I'm not sure what we're being liberated from, but today is Liberation Day. We will not be doing a show today because it is a national holiday. I wish. But so today, as I was saying earlier, this is going to be kind of the defining moment for markets today. The question is whether or not the market has already priced in the impact of these tariffs, or if there's more to be priced in, right? We're going to find out today. And then on Friday, unfortunately, we're not out of the woods just yet, because on Friday, we have the employment number. And if the employment number comes in exceptionally weak, which would increase the risk of potential recession, then that might weigh on stocks more. However, the other side of that is that if the employment number is exceptionally weak, maybe the market goes back to bad news is good news, because that'll mean the Fed will start cutting rates more aggressively. Again, market volatility. Don't know how markets are going to play this stuff out. And this is kind of what I was saying, is that this is a really, really difficult market to hedge right now. Because, and what I mean by hedging is like, I'm going to short, the Mag 7 and I'm going to go long the 493, right? I'm going to hedge my portfolio that way. Well, the problem with that is that any type of news flow that comes out is likely going to see money move back into momentum, in other words, the Mag 7, and now you're on the wrong side of the trade. It might work out fine, too. I mean, maybe money flows up more out of Mag 7 and goes back into the 493, kind of the more defensive plays, potentially, right? But what I'm saying is it's a very difficult market to know how things will play out. Yesterday was a really good example of this. If you take a look at yesterday's heat map, it was very green in the Mag 7. So all of them were up yesterday. So again, the very, very difficult market to hedge. And that's just, sometimes that's the way it is in investing. You sometimes you just got to, just wait. And there's always, as we've talked about before on the show, there's always this kind of need to do something. I need to do something. Sometimes the best thing to do is to do nothing and just kind of suffer the slings and the arrows for the moment, and then we can figure out better about kind of what the market's trying to adapt to, and then start placing some trades accordingly. But this is just one of those moments where we really don't know what's going to come out of the White House and how the market's going to interpret it. I mean, again, they could come out today and say exactly what everybody expects: 25% tariffs on everybody, right? And the markets go up because it's already priced in. Or maybe they come out and say 25% tariffs on everybody and it wasn't priced in, the market goes down. That's the problem that we don't know. We just don't know how the markets are going to react. We can all guess at it, right? We all have our assumptions, right? So everybody's got an assumption about how things are going to turn out today. 50% are going to be right, 50% are going to be wrong. I just don't, and I just don't know which side of I'm on, right? So I don't know how today's going to work out. So, kind of our best course of action today is to just sit and wait. The portfolio's been performing well this year so far, so I don't have a lot of stress on the portfolio I've got to deal with. So that gives me a little bit of breathing room here to just wait for things to happen. And sometimes, again, like I was saying, that's just sometimes kind of the best thing to do. Because generally, if we try to do something, more often than not, it turns out to be the wrong thing, and then we're really kind of got to work ourselves out of a problem. So that's just kind of where we are. Okay. Outside of that, we will kind of focus on Liberation Day today, what that's going to look like, and then tomorrow, when Michael Leibowitz is here, then we'll get into more details of what was said, how that's going to impact markets, and then kind of where we go to from here. From the economic data standpoint, that's not been great lately. ISM manufacturing came in a little bit weaker than expected, not dramatically weaker, but we are seeing price pressures in that. Now, you've got to discount the price pressures. Lots of headlines out is, a lot of this economic data, mostly surveys, are showing decreases in employment, decreases in new orders coming in. So definitely seeing some weakness economically speaking coming into some of these reports, but the focus goes back to price pressures. And if you'll notice, there's two things that are going on. Big surge in inventories, surge in price pressures. That's tariffs. That's all the front running of tariffs. So when you're taking a look at this data, be careful looking at that data, then trying to extrapolate that out into saying, oh, this means that, this is going to be more inflationary, because these are very one-off issues right now going on with manufacturers on both the service side as well as the production side. We're seeing increased cost pressures to get ahead of tariffs. So again, you saw people go out. New car sales have jumped here over the last couple of months, trying to get ahead of auto tariffs. We've seen a big surge in inventory. So manufacturers are pulling in inventory right now to have all the stuff they need to build whatever they need before the tariffs get put into place. So they're trying to get ahead of that. So they're building inventory ahead of these tariffs. That demand is leading to an increase in prices, because again, if all of a sudden, if I'm a Chinese manufacturer of some product and I'm selling it to the US, and all of a sudden I've got this massive surge in demand, I'm increasing my prices. So not surprisingly, you're seeing some price increases in those like ISM reports, the manufacturing, the S&P Global reports as well that came out yesterday. We're seeing some increase in price pressure. Just be careful extrapolating that out into the future, because the problem now is that's actually a disinflationary action, because now I have a bunch of inventory that I'm holding, and if my demand is slowing with the economy, I've got to liquidate that inventory. I have to liquidate that inventory at what? Reduced prices. Everything's on sale, right? 25% off on Walmart. But that's what we see, right? So that's going to happen. So again, just be careful with some of this economic data. It's really easy to start constructing narratives out of really short-term impacts to data, but we also have to remember that there's a exogenous event that is currently occurring. Those are tariffs that's currently occurring in the markets that's creating these kind of anomalous factors in some of this data. Again, I'm not dismissing the data for what it is. It is. But it's interesting when you take a look at, great, I'm building all this inventory at a time where new orders are dropping off. Think about that for a moment. I'm building inventory at a time where new orders are declining and I'm laying off workers. That doesn't suggest that the economy is roaring on all cylinders by any stretch of the imagination. And then also, too, remember that a big chunk of these imports have been importers of gold to get them out of foreign banks, bring them back into the U.S. to avoid the tariffs on the imports of gold as well. So that's been weighing on the GDP Now report. However, that GDP Now report is now a negative, like 1% GDP growth for the first quarter, real, even if adjusting for the gold imports. So now, again, there's still, you know, if we have a strong employment report, that number is going to go flying up higher. So again, you got to be careful with that. It's running on some lagging data, trying to run real time. Most economist estimates for the first quarter have declined also, by the way. Economic growth estimates for the first quarter have fallen to about 1.8% for the first quarter, down from about 2.5 when we started the quarter. So definitely seeing some weakness in the economic data starting to filter through to economist estimates, but there's a big gap right now between kind of what the blue chip economists, Wall Street, et cetera, expects about the economy versus the Atlanta Fed GDP Now. Those are going to reverse and start to kind of meet in the middle somewhere. So we'll see probably by the time we get to this end of the kind of start getting the first reports for the end of the quarter. Now remember, we're just moving into April. So we're just now about to start getting all of the March data. So all the March data will now start to feed through. Now that data is not going to be great. You had a decline in the markets. You've had, multiple impacts to consumers over the course of the last month. And again, decline in the markets certainly not helping their sentiment to go out and buy stuff, right? So I would expect that data to be weak, but probably we're going to wind up first quarter around 1% growth. We'll see somewhere around there, maybe 1.25. It's going to be weak. That's likely going to be the trend this year. But going back to manufacturers, they're building inventories in an environment you're going into weaker growth. That doesn't work out well. So, all right, we'll be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your your payout. Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
$1 million sounds like a lot of money, and a lot of people don't have $1 million. It's not that much money, considering that most people's net worth isn't $1 million in cash in the bank. That's their house and all their other stuff. That's not liquid. Because if you want to extract the capital from your house, you got to sell it. That's awesome. Where are you going to live?
The Real Investment Show podcast. Same show, your schedule.
I'm going to live in a van down by the river
at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just real quick, something on tariffs. I was just kind of reading through chat, some comments that were kind of rolling on. By the way, if you're watching our YouTube channel, we appreciate it very much. You've been helping us grow. The channel has been growing this year, and I certainly appreciate all your support and help. And you help us by, of course, liking, subscribing to the channel, commenting in the chat. We appreciate it. And if y'all would comment something about the show, that would be awesome. I could talk to you about it, but some of your narratives I can't repeat because we're also running a radio show. So some stuff we can't talk about right now because of FCC rules. So just got to be aware of that. But anyway, some comments, I've seen quite a few comments lately about tariffs, and there seems to be a fairly decent misunderstanding about Trump's tariff policies. And that misunderstanding is that people are thinking that, we're instituting all these tariffs and on everybody else. We're just making this so difficult on everybody else. We're being the bully in the room, so to speak. And that's not really the case. I've got a chart for you. It's from Bloomberg. If you're driving in the car, don't try to look at this chart. You'll have to watch the YouTube replay when you get to work, realinvestmentadvice.com. Just go to the Real Investment Show on our YouTube channel, and you can always watch a replay of this. But I'll explain. This is a map of the world, and the map of the world is broken down by colors. And the colors of the map show where we have free trade, which is right now just a sliver of Mexico, Canada, Mexico, and Australia for the most part. A little bit of a sliver in South America. And all the other colors represent where the tariffs in those countries exceed the tariffs of the U.S. And this is the misunderstanding. Most people think for some reason that other countries aren't charging us tariffs. So in other words, when we sell a product, so 40% of the revenue of U.S. corporations come from exports. We're exporting goods and services to other countries around the world. Those countries have enacted tariffs on the stuff that we export to them. They're making the cost of our goods that we and services that we export more expensive for foreigners to purchase, to make it more competitive on the goods and services that are manufactured by that country itself. So in other words, India or China or whatever, they have tariffs on our products. And so when we export to those countries, they say, hey, instead of buying that US product, buy this Chinese product because it doesn't have a tariff on it. It's cheaper. Right? So if you take a look around the world, Africa has the highest, parts of Africa have some of the highest tariffs in the world relative to us, right? So their tariffs exceed 10% or more. But you even get into China, their exports are 5 to 10% or 2 to 5% more than the US. So again, part of what Trump is trying to get to is he's saying, look, I'm going to institute these tariffs because it's an unfair trade relationship between the U.S. and our trading partners. And of course, I've seen lots of headlines over the last week or so talking about, Trump's trade wars is, treat your allies, all your allies, you need to treat them nicely. We are treating them nicely. They're tariffing us. All we're saying is look, we're just going to do a reciprocal tariff. You're going to tariff us, we'll tariff you back. We'll make things equal. So now all of a sudden, those countries which do not have the economic growth rate that we have in the U.S. are going to be faced with a challenge. They depend upon, just like we depend upon our exports to those countries, they depend upon their exports to our country. Think about things like French champagne. I'm picking something, right? Just anything, but you can pick any product. How much champagne is consumed in the U.S.? I don't know. I don't have I can look it up real quick, but it's a lot. I'm sure that the champagne industry depends upon the sales of champagne to U.S. as a function of their revenue. I'm sure we consume quite a bit of champagne in the U.S. So obviously, if we start tariffing French champagne, then U.S. citizens can go, well, I'll just buy sparkling wine. Because you can't call California champagne. You can't call it champagne. Sparkling wine from France is the only thing that can be called champagne, right? They've got a lock on that. So we can't call our champagne champagne. We have to call it sparkling wine. But as consumers, we have some pretty good California sparkling wine. So as a consumer, what's your choice? Well, I can't afford Moet, so I'm going to go buy, I don't know, I don't drink enough champagne to know what a good sparkling wine out of California is, but I'm sure you know one. Maybe you can throw one in the chat for me and help me out. But you get my point, right? There's a substitute. So all Trump is trying to get to with these tariffs is creating a fair and balanced playing field. Now, if you don't like the tariff, France, take your tariff off the products that we're selling to you, and we'll remove our tariffs on your French champagne. Again, we have free trade with other countries. We can have free trade with you. That's all he's trying to get to ultimately, is to have a fair and equally balanced trading relationship, which would benefit U.S. companies because of the reality that 40% of their revenues come from exports. So there's a benefit to U.S. workers, because obviously if those tariffs get removed on that 40% of exported revenue, or exported products. That increases the revenue flow for companies. They can produce more, sell more, hire more employees, raise salaries, all those type of things, because now that burden is gone. So that's the goal. This is not, though, an isolated incident where we're just going after the world with a billy club and just, hitting people over the head for no reason. It's not like that they don't already have tariffs on our products that we're selling to them. We don't tariff them, but they tariff us, right? That's what President Trump is trying to fix with these tariffs. So again, just important to have a base of understanding about tariffs and understand kind of what the goals are here. The goal isn't just to arbitrarily just throw tariffs on people. It is simply a function of trying to get to a fair and balanced trade relationship. And again, when you look around the world as a whole, we start seeing where a lot of these other countries have tariffs on the U.S. already. So, that's kind of the point here. So anyway, we'll see. Well, again, at the same time, I certainly understand the concerns, right? We've been through a trade war once before with China back in 2017, 2018, 2019. It wasn't the end of the world, importantly. Markets did okay. Economy did okay. Inflation actually fell during that period of time. So again, a lot of the concerns, and again, this goes back to the economics as well. A lot of the concerns about tariffs are more just kind of mental machinations at this moment. I mean, just we are trying to just assign some, depending on who you are, either trying to assign either the worst or the best outcome, depending on whether or not orange man bad, orange man good, right? That's how markets are working right now, or at least headlines are working from the media. But again, the one thing we've got to go back to and just remember, and it is just with the example of French champagne, that's a really good example of this, is that there is choices for, there are choices, my grammar good, there are choices for consumers to make to avoid tariffs. So this isn't necessary, and this is why tariffs are not always inflationary. Yes, tariffs may be inflationary from the standpoint that it increases the price of what's being sold or bought. But the one thing, so when economists take that, they go, if I take that tariff and I just slap it on the inflation rate, that's going to cause inflation to go up. But what they forget is about consumer choice. If you don't like, slap a 25% tariff on French wine, there's some really good California wines, right? There's really good. If you take a look at that kind of free trade chart we showed you a second ago, one of the countries that we have free trade with is Chile. Chilean wines are good. My point is there's choices. Consumers can adapt, consumers can make choices. And that will have impacts on the economy, it'll have impacts on inflation, it'll have impacts on all that. But again, we have to just kind of keep some balance to the perspective and not get so wrapped up in the headlines. Okay, we'll come back, get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Last year, bonds were under a lot of pressure. Interest rates were going up because economic growth was still very strong at that point. And again, as we talked about before many times, if you really want to know where interest rates are going, just take a look at economic growth and wages. That pretty much dictates what drives both inflation as well as interest rates. And interest rates are simply just a byproduct of economic growth, because economic growth drives demand in the economy for loans, borrowing, etc. So if you really want to know where interest rates are headed, just pay attention to GDP and wages, because that's what drives interest rates. So we were writing some articles last year talking about why interest rates will decline, and that'll also be a function of declining inflation as we kind of go forward. And there was a lot of articles being written, and we saw, Stanley Druckenmiller and Paul Tudor Jones out saying, Paul Tudor Jones wrote an article, about that. It's like, I won't own bonds, right? And, he was actually shorting bonds. So, and again, we warned you then that he was probably talking his book at the time, and that was a trade that was working at the time. Now, what he's doing right now, I have no idea. It could completely change, because this year bonds have obviously been outperforming stocks to a large degree. So, owning bonds have been a good hold. So I thought it was interesting, though, that again we go back and talking about the drivers of inflation and interest rates, right? It's the economy. It's the economy, stupid. And I thought it was interesting today. This morning, Goldman Sachs came out, and they aren't waiting for, this is the headline, strategists at Goldman Sachs aren't waiting for President Donald Trump's Rose Garden announcement to change their view on Treasury yields. Citing a more severe tariff baseline, Goldman strategists led by George Cole lowered their year-end forecast for the 2-year and 10-year Treasury yields. The 2 years expected to finish the year at 3.3%, down from 3.95%, and they're expecting the 10-year Treasury yield to fall to nearly to 4%. Now we're at 4.1 right now. If tariffs lead to slower economic growth, and the current trend of economic growth that we are tracing right now continues, you're going to see yields below 4% this year. And that wouldn't be surprising. Again, when you start talking about 1.5%, 1.6% economic growth in the first quarter, if that continues, if we don't see a rebound in economic activity above 2.2%, you're going to see sub 4% yields on Treasury bonds. Again, we go back and right now yields are trading about where they should. If you take a look at inflation, you take a look at GDP, and you take a look at wage growth, where we're tracking right now is about right on Treasury yields. They're about fairly valued for the markets and the economic dynamics that drive yields. If that continues to deteriorate, as it appears at least at this moment that it will continue, yields are going to decline more this year. So again, it's just, but the point is that we go back to last year, we warned you that there was a lot of these headlines talking about interest rates going to 6%, interest rates, and we're like, that's not going to happen. Be careful with that narrative. Again, great, bear porn to drive clicks and views, those type of things, but the economic dynamics didn't support it then and doesn't support it now. Again, if you go to our website, realinvestmentadvice.com, if you just type in Stanley Druckenmiller, you type in, Paul Tudor Jones, you'll get articles that we'd written last year about this stuff. And again, this isn't surprising. This is what you would expect to occur in a slowing economic environment, particularly one where you don't have monetary inputs in terms of, big spending bills. We haven't passed another Inflation Reduction Act. We haven't passed another, spending bill, the CHIPS Act, those type of things. We haven't done any of that. And now you're, impacting on tariffs, which is going to impact revenue. You are going to get a reduction. If you increase the cost, you're going to get a reduction in demand, right? You can't increase cost and keep demand high. We don't have the economic environment for it. Personal savings rates are declining. In fact, that was kind of one of the articles that, in fact, we just posted this morning in our daily market commentary. If you're not subscribed to our daily market commentary, we put that out every morning at 7:30 before the market opens. Quick little 3-minute read about what's happening in the markets, little tidbits to try to, just kind of get you geared for the day, just what to expect. But there was a discussion here lately. We've talked about the inflation expectations, particularly in the University of Michigan Sentiment Index. That is a deeply flawed measure right now, because when you take a look at inflation expectations just at the headline, inflation expectations have risen. But when you dig down into it, it's solely a function of Democrats versus Republicans. Republicans expecting about a 0.2% inflation rate. Democrats expecting 6%. So you've got this huge skew in political sentiment right now that's driving those inflation expectations. So you really have to discount that to a large degree, because that's simply just emotion, not really actual data relating to inflation expectations. So you kind of, and even Goldman Sachs, it's not just our opinion, even Goldman Sachs came out just recently, did a whole big dissection of inflation expectations and said you just got to dismiss it for right now because it's all political bias. But what isn't politically motivated, Brent, can you bring this chart up for me? But what isn't politically motivated is the savings rate. And savings rates are declining. You can see that massive spike in the savings rate that we had back during 2020. That was when we were sending checks to households and we shut down the economy. So everybody had money but couldn't spend it. That's fallen and has gone away now. And we are now starting to have a return to normalcy with the savings rate. Now, two things about this chart are important before you take me off of this, Brent. First of all, the rate of savings is declining. That suggests that you're going to have slower economic growth because you don't have as much money to spend saved up in the bank. You're running out of savings. So you're now going to have to start tapping on credit cards. But we have already looked at consumer credit and are seeing delinquency rates rise on consumer credit cards. So the consumer in the bottom 90%, which comprises about 50% of the economy in terms of spending, are starting to struggle. But the second thing to note is that the recent data shows an uptick in the personal savings rate. And we saw this. I mean, we're currently running about a 5% savings rate. That is not recessionary. It doesn't support strong rates of economic growth, but it's not recessionary. So this is kind of two things to take away from this, because again, this is actual data, right? This is just a measure of income versus savings. Is that the what we're looking at here is a slower economic growth environment. Again, going back to what's going to drive yields is going to be the rate of growth in the economy. This data doesn't support an economic growth rate like we saw over the last 3 years, where we had just this massive input of monetary influence. Now you're going to put on top of this, you're going to put on tariff rates, et cetera, which is going to increase the cost of goods and services to some degree, depending on whether or not the producer can pass those on. But that's going to impact somewhere, right? It's either going to impact on economic growth in terms of the consumer, or it's going to impact on economic growth from the producer. And part of the GDP equation, there's two components to the GDP equation that are being impacted here. One is the personal consumption expenditures. That's roughly about 70% of GDP, how we calculate it. Excuse me. If the producer can pass that on to the consumer, that's going to potentially impact consumption, given the fact that they are running out of savings. Higher cost, inability to purchase. However, the other side of that equation is, let's say the producers can't pass it on. Well, if they can't pass that on, they've got to eat that. That's going to impact earnings, which is going to reduce their business investment. If I'm having to eat costs and I'm not selling as much goods or services, then I'm not going to be making business investments. I'm not going to be, building out new plants, new property, new equipment, making new acquisitions, those type of things. Well, business investments is about 15% of the GDP equation. So those two get impacted by tariffs either simultaneously or separately, but it's going to impact economic growth. And the question is just, we don't know yet on which side of that equation is, but all signs point to slower rates of economic growth this year, and lower rates of and lower rates of inflation and lower rates of interest, just as a function of that process. So we'll see. Doesn't mean that in the meantime you're not going to see bumps up and down in the data, right? Year-over-year comparisons, you get a weak period versus a strong period. You're going to see bounces in the data, not surprising. Not saying that inflation is going to fall off the cliff this year, not at all, but it's going to kind of just keep trending. Most likely it'll be sticky here for the next few months and kind of trend a little bit lower later this year as that economic reality becomes reality. So again, don't expect an immediate return to 2%. It's going to be kind of over time, but that's going to start to drag on yields as we go forward. And the more that we see this economic data come in weaker than expected, which is what's been happening this year so far, if that continues, the bond market's going to start pricing for much lower rates of economic growth as well. So anyway, wraps up the show for this morning. Be sure to get by the website, realinvestmentadvice.com. The daily market commentary is out already. Michael Leibowitz's new blog out this morning. It's on the website, realinvestmentadvice.com. He'll be here tomorrow. We'll talk all about Liberation Day, what it actually means once we actually know what we've got, and we'll talk about how the markets react as well. Markets are pointing down lower this morning. We'll see if they can recover today, kind of once we kind of get underway. But sit tight, and we'll talk about it tomorrow. Have a great day. See you next time.